morning, New York. Good afternoon, Switzerland, and good evening in the Middle East. Amer Bizhat is here with us today, and on behalf of the family office and Petrol, we thank you for joining, Amer. As you know, the family office was founded in 2004 to safeguard the assets of very large families in the GCC, and Petrol is the asset manager based in Zurich, a FINMA licensed asset manager with a focus on private markets. We are thrilled to have Amer with us today. A bit of background, he served as a senior economist at IMF. He taught at Columbia University. He co-authored several books and papers, and he is currently the head of sovereign and emerging markets at BlackRock. As you all know, this is the largest asset manager in the world. Him and his team, they run close to $20 billion of assets under management. Welcome, Amer, for joining us today.
Thank you very much, Naji. It's a pleasure and honor to be with you. I feel a great affinity to your organization. Abdel Mohsen is a very close friend, and I have the ultimate respect for him and for the rest of your team. Thank you for inviting me.
Great. So Amer and I, we prepared several topics which we will discuss around emerging markets. Of course, also we have the chance to ask any question. There is a chat box, type your question, we will take them. We're gonna do around 45 minutes discussion, and then we wrap it up. So let's start. Amer, you know, today when I opened the Bloomberg, you know, whenever you open the Bloomberg terminal, you have the quote of the day. And today's quote was by Miguel de Cervantes, you know, the famous Spanish writer who wrote Don Quixote. And his quote of the day was, "To be prepared is half the victory." So in your opinion, do you think emerging markets were prepared for this crisis, unlike the other crises before?
It's a very good question, and it's a great quote, actually. And to get somebody like Don Quixote's author to talk about emerging markets sounds fairly relevant today. Listen, Naji, I think emerging markets were better prepared than previous episodes, but not prepared enough, right? And let me be a little bit more precise. They entered the crisis with better conditions in terms of debt. Their debt level were lower than they used to be. And that's always a good idea, because now I'll get back to that in a second, you had the ability to raise your debt to offset the crisis. They came into the crisis with lower need for dollars. Not to be too technical, but the current account deficit, how much dollars do you need from the rest of the world, was less than it used to be in the past. And they came to the crisis with a higher level of reserves. So they had a cushion, they had insurance in order to use in case things really got bad. And all three of these things really, really helped them, right? They were able to do significant fiscal policy, which was really good. They were able to spend money to offset the crisis. That was a good thing, which meant that they had to raise their debt. We'll get back to that later. That worries me. But at least in the short term, they were able to face it. They were able to cut interest rates very aggressively, which is good, because that means there's more liquidity in their economy as well. And they were able to intervene and use some reserves in order to offset the shock. So they actually ended up weathering the shock better than in previous cases. Were they perfectly prepared? No. And I'm going to emphasize two things. One, the emerging markets of the 1990s is no longer the case. The high growth rate that we saw in the 1990s in emerging markets has not been the story for the last 10 years. EM has been growing well below its potential. We can get into the reasons why, but that's been an issue. So they faced a shock at a time when growth was not good. This is very different than the US. The US faced the shock when growth was really good, not in EM. And the second thing is politics. Politics was really messy in EM in the last few years. A lot of elections, noise, populism, demonstrations, And that's not a good environment to be offsetting shocks when your politics is not very, very, very solid. So long story short, economically, they were prepared. They were able to offset the shock properly, but the initial conditions in terms of growth, prosperity, and the political backdrop, much less so.
Great. And I think, when we talk about emerging markets, we put them all in the same bucket. And hopefully, as we go in the discussion, we can differentiate between regions, countries, because it's not only one emerging market. We have many of them. Amer, what are some of the themes you are watching for 2021? And if you're, today listening to this webinar, 2 or 3 themes that we should be looking for in 2021?
Completely. And here we're not talking about markets yet, Naji. We're talking about the fundamentals. Eventually, we should be talking about how do you trade it, how do you invest it, right? This is still more at the theoretical level.
Absolutely.
I am focusing on a few things, right? And these, I think, are going to be the themes for the next 12 months. On the positive side, I want to see how the growth rate that we're seeing in the rest of the world is going to help emerging markets. And the one thing that's very clear to me is that the developed world is going to go through a growth, is currently going through a growth phase that we have not seen since maybe the 1950s. Right? And that's because of the fiscal policy, the monetary policy, the opening trade post-vaccine. So the first thing I want to see is how does this growth translate into growth in the emerging markets? I'm optimistic on that front. We're already starting to see the impact of that pass-through helping. We're starting to see green shoots in EM that we have not seen for quite a while. And here, parenthetically, this is the role of commodities. EM, let's not forget, is predominantly a commodity exporter. It benefits from higher prices of commodities. So the growth that you're seeing in the developed world is translating into higher growth, higher commodity prices, which is helping emerging markets. So that's on the positive side. A positive thing that I think is going to be a big theme is how do we benefit from the tailwind of global growth? A second positive thing is we're being surprised by what we call the opening trade in EM, the vaccine. The vaccine implementation in emerging markets, the ability of the countries to handle the pandemic is not perfect, but it's proving to be better than we thought, right? So when I look at the lag, the vaccine lag between the DM and the EM, we thought there was going to be 1 year, right? So we'll get to herd immunity in EM and DM in the third quarter this year. We thought it will be a year later in EM. No, it looks to be much, much shorter. EM is actually doing a better job at the vaccine. So that's on the positive side. Global growth, reopening trade. What worries me? Really, what worries me is the debt, right? EM has increased its level of indebtedness last year a lot, right, by 11 percentage points. The average right now, debt to GDP for all of EM is above 60% of GDP, which is a level that I always make me nervous. Half of EM has debt levels above 70 percentage points of GDP. A third of EM, one out of every 3 EM countries have debt to GDP above 90% of GDP. This worries me. And this is debt that needs to be serviced. This is debt that has to be paid for every single year through interest payments. And it's a question mark. Which countries will face difficulty servicing this debt? So growth is good. The vaccine story is better than we thought. I'm worried about debt.
You know, I had prepared my third question on that debt to GDP because true, debt in EM have increased and it is close to 60%. But when we look at it relative to developed markets, it is at 110%. And therefore, from a relative value perspective, when you look at, for example, the 5-year on the US is less than 1%, debt to GDP around 80%. Look at Europe is negative on the 5-year, and debt to GDP is around 60%. China is giving you a yield close to 3-4%, and its debt to GDP is maybe in the 40-50%. And what I was going to ask you is whether, from a relative value perspective, I'm a global investor, not only at looking at it from an EM perspective, but DMEM, is, for example, buying Chinese sovereign debt today is safer bet than buying a US debt today, sovereign.
So I'm going to separate, that's a great question, actually. Thanks for asking me. Let me separate Chinese debt for a second. China is a different entity altogether. China is not emerging markets at all. So we can talk about China and the debt level that there is, right? And I want to emphasize, and also, you know what, I'm going to also be a little bit more precise, and I'm going to also ask you to ignore the countries in the upper echelon of emerging markets who are also not really emerging markets, right? And those are countries like Korea, Taiwan, Poland, Chile. There's countries in that zip code that I would not consider emerging markets anymore. They're much more look like DM, right? But the reality is those are countries whose debt you also don't want to own anyway because the interest rates are so low on those debt that, I mean, Polish rates today in real terms after inflation trade below Germany. Makes no sense to own Polish rates, right? So that I'm going to ignore them, right? Instead, I'm going to focus on what I think your audience and your colleagues are interested in, which is quote unquote true EM, right? And sort of the Mexicos and the Brazils and the Turkeys and the Indonesia and the Russias of the world, right? And when people tell you that debt level of these countries is still below that in the DM, they ignore the possibility that those countries cannot print dollars. Those countries cannot print resources. These countries cannot service their debt by getting the central bank to buy their debt. Because if they do, the currencies come under pressure because you're effectively printing money, right? So the argument I'm trying to make here is that even though those countries may look to have better, lower debt than the developed world, I'm not convinced that's an okay thing. They cannot tolerate, there was no way they can tolerate the debt level that the US can tolerate. Why? Because the US can buy its debt. Brazil cannot buy its debt. Brazil needs me, needs you to buy their debt. And we need higher interest rates. We need better returns to buy their debt. So, so long story short, my concern on the debt level of these countries is genuine, even though those countries may optically have lower debt than the rich countries.
Very nice. Thank you for clarifying this. Let's speak about China. So what's your view on China debt, also China politics? You know, after Trump, the China trade war was a big topic with the US. How's Biden? So give us your view on all of this, all of the above.
Yeah, no, let me start with the opportunity set, the trading, the investing, and then we can move to the fundamentals in this case. I actually think Chinese rates, Chinese bonds are very attractive. Right? You're getting, as you pointed out, Naji, you're getting, this is a country that has the ability to tolerate very high level of indebtedness. Why? Because it's a country that, I mean, we can get into the details. Savings rates are extremely high, so the population can buy its own debt. You don't need Amr Bsat, you don't need Naji to buy their debt. The domestics can buy it. They're sitting on $3.25 trillion worth of reserves. So they can always use those reserves to buy the debt if they ever need it. They have a closed capital account. When the thing hits the fan, they close the door, money doesn't leave. They're stuck, it's captured, right? It has a balance sheet of the country, has a balance sheet, even though the private sector may have high debt, the public sector debt is really low. And you're picking up 3.25% in the 10 years, right? This is compare that to the US, where you're making what, 1.4 or 1.45% with a higher level of indebtedness. Again, not to compare apples to apples. I mean, obviously, US and China are different, but China has a AAA developed market characteristics with high savings rates, huge reserves, closed capital account, low debt of the public sector, and you're still picking up 200 basis points over over the US in a currency that is fundamentally cheap. CNY is a cheap currency. So I actually like that trade, and I think it makes tons of sense. Chinese, it's very interesting, your question about, because we've been spending a lot of time on Chinese-US relationships. Two comments on this. One, we make a big mistake if we think that the policy is not changing between the US and China. It's changing a lot. While the emphasis before was on trade account and aggressive pushing by the Trump administration, hoping maybe unrealistically that if they push hard enough, China could collapse the way the Soviet Union did. The Biden administration has a very different approach. It's much more systematic, much more slow, much more gradual, much more comprehensive. They're going to be squeezing them at every single level, not just on trade. They're going to be using coalitions. They're going to be squeezing them through the G7, the G20, Korea, Japan. They're going to try to, which brings me to my second extremely interesting point. Paradoxically, even though the noise has come down, even though it looks like the relationship is smoother, over the long term, the Chinese are much more scared of the Americans today than they were last year. Much more scared. Last year.
Why?
Because last year they thought that they could wait it out. They didn't think it was too serious. The trade account, the trade surplus, trade deficit, their trade surplus with the US became bigger after the tariffs rather than smaller. I mean, it's shocking, right? I mean, the tariffs, they did not take the tariffs seriously. They were able to onshore. They were willing to wait out Trump because they thought he was a one-trick pony, right? Tariffs, tariffs, tariffs. They're much more scared of this approach, which is more systematic, much long-term. So we're going to be in a long period of slow tension, like a Cold War, right? Because they're reacting to it in a way that they were not reacting in the last 2 years. So it won't be as noisy and worry and like a hot war, but it will be a long course. And I know for sort of reasons that they are worried in a way that they weren't 2 years ago.
One more question, a bit more macro, and then we go on the portfolio level. Amer, you touched on it, oil prices up 50% year to date. What's your view on oil impact on inflation and then EM generally as well?
Absolutely. So the question we have to ask ourselves, Naji, here, and that's a big, broad question that I think the answer is a question on oil, but also on other things, is are we entering into a long period of global growth that is funded by aggressive fiscal policy, particularly in the US and in Europe? Do we have 10 years worth of growth and above trend growth funded by huge deficits that is being spent mainly on infrastructure, but also seeps into other manufacturing? If the answer is yes, if we are entering into a period of long-term growth, then we are in a super cycle of commodities. And that super cycle can more than offset, when you do the math, the impact of the reduction in demand that is coming as a result of alternative energy sources. So if you think we're entered into a long period of growth here because of fiscal policy, then we are entering into a super cycle. And there are smart people out there who believe that that's what we'll see. There's another theory that says, no, this is temporary. This is a sugar rush. What we're going through right now is a sugar rush associated with the reopening, right? A lot of pent-up demand and policies that cannot remain forever and ever. At some point, fiscal policy is going to be returned because the level of debt is becoming too high. Inflation becomes a constraint because you're printing so much money. So we're entering into a 1 year, maybe 18 months worth of strong growth. So commodity prices are going higher for a short period of time, but eventually reality, alternative energy sources becomes the fundamental driver and commodity prices drop. I have to tell you, it's very difficult to make a call right now. I tend to be a little bit more on the pessimistic side. I think the policies that we're seeing in the developed world are unsustainable. Eventually, some form of course correction is needed. Some form of tightening of policies is needed. So I'm not convinced that we're having a 10 years worth of growth in front of us of this kind that we're seeing right now. I think we're going through a sugar rush for a year, 2 years. And eventually, the fundamental reality comes back and oil prices come down to, energy prices come down to a lower level than where they are right, even where they are right now. Now, the implications on EM are very obvious, of course. Anybody who buys the commodity produces on more than tactical, right? If you want to buy Brazil, if you want to buy Russia, if you want to be buying Colombia, Indonesia, all these commodity producers, and you think that this is a super cycle, this is similar to the early 2000s, I think you make a mistake in this situation. If I'm right, and this growth phase ends up being short-term in nature. I am more of the, we buy them as a tactical trade. We benefit from where we are right now. This is a 6 months trade. This is not a 10-year asset allocation trade. Because eventually, I think the policy retrenchment in the developed world is going to cause not just higher interest rates, but also lower growth and lower commodity prices. And this is when you have to be careful about owning these kinds of high-yielding emerging market assets. I'm not saying we're not owning them. I'm not owning them right now. I like them. But this is more of a, I want to rent them, not buy them, not own them.
What makes you feel different today? I mean, the fiscal stimulus that have been put was much higher than the great financial crisis. And in the last crisis, we ended up on a super cycle or a bull market, maybe not much for oil, but on a bull market for 10 years before COVID hit. So why aren't you convinced that this time, despite more liquidity being put in the market, we might not see a 10-year bull cycle?
So listen, I am humble enough to know that that you can never, in finance and markets, you can never say 100% sure, right? So yeah, I am one of those people who probably was a bit nervous after the great financial crisis, and I did feel that the expansion was artificial, right? And let's not forget, Naji, that you look at it over 10 years between 2008 and 2019, and it looks great. But remember that we went through multiple crises in the interim, right?
Yes.
We had the European crisis, you had the big China crisis,
the oil crisis.
Energy crisis, 15, 16, right? We had 3 or 4 periods. And also, let's not forget that the attempts at removing accommodation when they tightened policies was also painful in 2013, right? But still, you're right. Over a 10-year period, you ended up being fine. Why would it be different this time? I think it's going to be different, maybe different this time for 2 reasons, right? The first is the scale. This is unparalleled. If you compare the amount of fiscal monetary expansion this time to the global financial crisis, it's not even in the same zip code. And we are spending what we spent in 2008 every 6 months, and we're doing it 4 times as much, like literally. And this is before the infrastructure push in the US. This is before the Stabilization and Recovery Act in Europe. So the scale, same thing with quantitative easing. Right? Money supply, the liquidity expansion that we saw. So global liquidity went up by $1 trillion in 08. It's gone up by 11. So from 1 trillion to 11 trillion during the COVID crisis. Scale is an issue. The second argument is, there's an expression in English: if you wait for the bus long enough, the bus eventually shows up. Like you wait. So all these imbalances are building up. And the fact that we haven't seen them doesn't mean that you eventually won't see them. And if you were to push me, what's the one thing that worries me the most? What's the one thing that could burst that bubble and make things unsustainable? It's inflation. My baseline is that inflation remains, global inflation remains well behaved. But But let's be clear, this kind of expansion, we should not reject the hypothesis that inflation is a serious risk. And if inflation is a serious risk, it could accelerate the removal of monetary policy, right? It can start, remember the Volcker period. So if you were to ask me what is the one thing that keeps me awake in a serious way, is inflation.
So then the question, and that ties us to now the portfolio construction. Before we start addressing how are you hedging against inflation, just maybe give us a bit of background around the investment process that you apply, you and your team on emerging market, and then we tie it into how are you building your portfolio.
No, absolutely. And I'm going to be fairly, obviously, it's a very complicated and a long process. But if I were to really simplify it, I would highlight a top-down and a bottoms-up approach to EM. And you need to do both. You cannot be just top-down, right? And top-down is three things, right? If you want to invest in EM, you have to ask yourself three things. One, what's the global macro environment that EM is operating under? You cannot ignore EM is a trade, like we are the tail and they are the dog. When they move, we wag, right? What is happening in the US, what happens in China, what happens in Europe matters a lot to EM. So you have to have a view on the global macro before you decide on the fundamental picture in EM. In EM, and that's the second still at the top-down approach, valuations matter. Valuations matter a lot. Right? There's so much research that shows you that the entry point, the step at which, the price at which you get into an asset matters a lot. You don't buy EM purely on fundamental, I like EM, it's going to be growing, commodity prices are higher. Valuations matter. You have to look at what is priced. So what's priced in of the good news. And the third thing that I look at is technicals, flows. EM is extremely flow-oriented. It's a very illiquid asset class. It really moves very quickly with flows. So you have to have a very strong view on who's buying and who's selling and where are they coming and how big and is the market too long, is it too short? We spend a lot of time on the technicals. Once you decide on these three things, you say, okay, now I think I understand the fundamental backdrop, I understand the valuations argument, and I understand the technical arguments. I'm going to buy or sell EM, and you have a view. But that's not enough.
Okay. Let's pause here, because I'm sure people are asking on each of these, let's say global macro environment, are you positive or are you negative today?
I'm on net, I am. I go through all three of them. On net, I am on the more positive than negative. I am on the right side of the center, right? This is sort of the argument we were saying before. We're going to be benefiting so much from global growth. Like the global growth backdrop is so powerful that at least for the next 6 months to a year, you cannot be negative on the EM story. But I'm very worried about debt. And I'm worried about, at some point, the ability of the countries not to service their debt properly. I put these two things together, and I am on the right side. I'm on the bullish side of neutral on fundamentals. I'm worried about valuations. I'm actually quite negative on valuations. We've priced in a lot. And I look, and so we have a complicated way of looking at all these. Like we look at these asset prices against the history. We are, except in FX, in EM foreign exchange, which is still above where they used to be historically. They're still cheap, above as in cheaper. The dollar EM is higher. EM FX is lower than the historical average. But everything else is actually on the rich side, on the expensive side relative to the last 3 years, 5 years, 10 years. When I look at EM valuations against their competitors, right? We have when you look at them and you say risk adjusted, I mean, they're not that attractive. We're not super rich. We're not super expensive. The entry level is not horrible. That's not really good. So I score that as a bit on the negative side. I'm very positive on the technicals. Very positive on the technicals. And I think the investors are still underweight in emerging markets. And I don't think they've been quite nervous about it. They prefer to buy US equities. They've been buying US. And I think, I think despite the fact that valuations are not attractive and fundamentals are mixed, I think the flow story into EM continues to be quite positive. So I put all these three things together. And from a top-down point of view, I want to be in EM. I don't want to be crazy long. Right? This is not the time to pound the table. I pounded the table last year in April, May, and we did touch wood. We did extremely well because we caught the entry point quite well. Now you have to be careful. You want to be long. So on a scale of 1 to 10, I'm a 6 right now. Right? I'm not neutral. I'm a bit on the long side, but I'd rather wait for better entry points to step into the asset class. But if you don't mind, I'm gonna conclude by sort of making the very important point, which is this is what my boss, the CIO, always says. He says in EM, it's funny. You may want to own it, but you can't find anything to buy. Right? So the bottoms up matters a lot in EM. You have to have a view on each and every country. You make a mistake in emerging markets if you do it only as a top-down view. You have to have a top-down view. You have to be, and as I was saying, I'm positive on it broadly, but it's very important to figure out which countries. You have to do a lot of country-by-country work on which countries you like and which countries you don't. It happens that I have enough likes and right now to build up a portfolio that is broadly consistent with this 6 out of 10, right? And we can go through the countries if you're interested, which countries I like, which countries I don't. But there's enough bottoms-up, country-by-country stories that allows me to build a portfolio that is moderately long at this stage.
Yeah, let's talk about this. So if you were to say the top three countries, and maybe China is one of them, but the top 3 countries that you like a lot to own, and let's also think about the top 3 that you don't want to own today.
Right. So let me start with China, because China is not my big short, but it's not something that, and here I'm thinking in terms, I love the bonds, as I was saying. Bonds, I think, is a great trade. I want to be slightly long the renminbi here. Not a huge winner. It won't be a huge winner. You probably want to be owning it. So you want to be owning the bonds unhedged. That trade I liked. Risky China, equities. In other words, when you talk about risk, you're talking about equities, but also some of the corporate. I'm more nervous about it. And I'm more nervous about it mainly because they are at a different part of the global cycle than the rest of the world. They are now, when the rest of the world is accelerating, they're decelerating. And the reason they're decelerating is because they were the first in, and now they're the first out, right? They really went crazy with accommodation, and now they're removing the accommodation, they're tightening credit, they're trying to stabilize, and the economy is slowing down. There's also regulatory developments that are making people nervous on the tech, on the antitrust. So not really my favorite trade here, except on the bond side. What do I like here? The countries that I like. I actually have, just again, Naji, in the nature of the 6 out of 10 view, nothing in EM right now is going to make you extremely rich. Let me be very clear. So everything I'm going to tell you is a B+ trade, not an A trade. There's no, at this point, I cannot find A trades in EM, right? They are all B trades, B+ trades, right? I like Mexico. I think Mexico is a place that the fundamentals are strong, really strong. They're going to be benefiting massively from the north, from the US doing extremely well. And valuations are okay, right? Things are cheap. The peso is cheap, rates are a bit on the high side. Equities have done extremely well, but they still score as a bit cheap as well. Brazil is a tactical long at this stage. Brazil is a good story. It has a lot of problems, right? I think the politics of it is really messy. And I think the fiscal problem there is something that we have to be very worried about. Like the pace at which they accumulated debt is really scary. But they are a huge beneficiary of the commodities, huge beneficiary. And they're cheap, right? It's a cheap asset class, like because of years and years of underperformance. And there are a lot of good stories in there. Like the private sector is in good shape. The public sector is horrible. There's a lot of good companies to own in Brazil that have been adjusted and cleaned up and strong balance sheets. And so eventually I'm worried about Brazil, but short term, I actually like it. Across the multiple oceans, I've always had a very strong view on Indonesia. Indonesia is a great convergence story. It's the only true emerging markets in Asia, right? Because I don't think of Korea, Taiwan, Malaysia as emerging markets, but Indonesia is, and I think it's going to be converging. I think they're doing a lot of things that's going to make them look more and more like Northern Asia. But they still trade like in emerging markets. You still can get huge yields, good multiples. And I actually like the policy path in there. Who worries me? Again, Brazil, I think, is something that's going to worry me a lot down the road. So I'm putting it as a long right now, but eventually I'm worried about Brazil. I think they have a fiscal problem and a political problem. So down the road, and by the way, I spent most of the last year being short Brazil. Only recently have I moved to long. But I think of it as a tactical. Brazil is something that actually worries me as well. I'm not going to talk about the basket cases. Unfortunately, your and my country, Naji, is certainly one of them, Lebanon. So I'm not going to talk of the really problematic countries. I'm talking about, so Argentina is not something I want to be touching here. It's such a distressed case. But Turkey worries me a lot. Continues to worry. At this point, it's becoming like a perfect storm of negativity. Like the fiscal is out of whack, the politics are out of whack, monetary policy is too easy. Their funding needs are unbelievably large. They desperately need dollars. COVID is really not helping them because of tourism.
And they import oil, no?
And they're oil importers, so the current account is actually now really deteriorating again. Now, again, they've been hit, right? So it's difficult to be outright short on Turkey, given how much they've been hit. But unfortunately, the path of the roadmap is not good for Turkey. And I think it's going to get worse before it gets better for a place like Turkey.
Great. Let me take some questions from our guests. So there's one question: as an asset owner, how do you reposition your portfolio with this inflation risk?
Yeah. So I have two answers to this. One is there is a direct way, right? And you hedge outright inflation. There are ways to outright hedge inflation. There's the TIPS market. Right? There's the break-even market in the US where you can essentially bet on higher inflation. So if inflation goes higher, you make money. So there is a break-even market that you can use, and it's a liquid market, and it's a good market. And the valuations they used to be better. Like a year ago, they were a great hedge. Now, less so because they're trading already we're pricing in 2.25% for 10 years of inflation. So it's already full. But if you want a structural backdrop it's a good trade. I think the better direct hedge for a portfolio is being short duration. Outright short nominal rates, right? If you go out there and you sell duration in the risk-free assets at these levels of nominal rates, but also underneath it is real rates. US real rates now trade. So in other words, interest rates in the US after inflation are at minus 100 basis points. They're negative. Historically, they're plus. Historically, that level is plus 50. You have 150 basis points of cushion here. So I actually like that a lot as well. So you want to be short duration. It's been painful recently, because rates keep on rising, even though inflation is higher. But I actually like being short duration in the portfolio. Then there are the indirect ways, Najib, which is what I call the assets which are assets globally that have priced in perfection, and as a result, will be hurt if we don't have the perfection. If inflation picks up, even though those assets are not inflation assets, but they've priced in a perfect scenario of accommodation, of easy policies, of high growth. So they're very vulnerable to a reversal, right? And here I'm thinking of things like investment grade bonds. Investment grade bonds are so tight here. They are so small that if you're wrong and the word is okay, I don't know how much they're at. Right? In the meantime, the carry is so limited. I mean, you're buying them at what, 1.5%, 1.75%? Yeah, there's negative carry, but not a huge negative carry. But if inflation picks up and the Fed has to tighten aggressively, these things can really sell off. So being short these low-yielding convex trades makes sense in a scenario like
this. Another question on yourself being a market participant in the past 30 years. I'm sure you had your fair share of hard lessons, especially in emerging markets. So what would be one hard lesson that you learned, can share with us?
Okay, there's the polite way of answering and the less polite way. I'm going to start with the polite way. The polite way is if you start investing in emerging markets thinking in terms of certainties, you make a huge mistake because there's nothing certain in EM. Emerging markets is all about probabilities. Right? It's all about distribution of possibilities around some baseline. So you have to have a view on where things are heading, but you have to accept that emerging markets, the volatility of the events. So you need to be prepared. And which brings me to my impolite way. You have to be humble and not intellectually arrogant. And my problem is, this is my hard lesson, is I came into this asset class a little bit late in my career because I had a career in academia and in policy. So I was at IMF and I used to be a professor. So I came to this, my first few years in the asset class in EM, I came in thinking, I know everything. And I'm sure I'm 100% right. And you make a big mistake thinking that you're 100%. Like you always have to be humble and not intellectually arrogant. So my very first serious slap in the face, obviously, was the Russia crisis. I was at IMF, and I used to be on the Russia team at IMF. Right? So I was literally in the middle of the Russia team, and I was one of the negotiators, a junior negotiator, but one of the negotiators. I thought I knew Russia. I had lived in Russia. I thought I knew this place extremely well. And I came to the market, and you very quickly realize that when you're in the market, you don't know anything. Right? You know a lot, but there's so many other things you don't know. You don't know valuations, you don't know the securities, you don't know the technicals, you don't know the psychology. So you have to be humble. So my lesson is in all markets, but in particular in emerging markets, humble, understand that you could be wrong, be prepared for all scenarios, and then step back and say, okay, given all these scenarios, what is the risk that I'm willing to take?
So we're up to 45 minutes, and I think you said be prepared, and we said in the beginning, be prepared to have the victory. So I think having you being prepared is going to get you to have the victory already in EM. On this, Omer, I really thank you for taking the time with us today. On behalf of the family office at Petrol, we thank you, and we hope to see you soon. I know it's been a while that we haven't seen each other, whether in Bahrain and Switzerland or in New York, but we hope to see you soon, inshallah.
I look forward to it. Thank you very much.
Thank you. Thank you, everyone, for joining us today. Bye-bye.